come across a new company that I've not seen before. Looks like it could be a stock to buy. I'm going to take it through my assessment process, and I'm probably going to be buying at the end of this. So let's take a look at it. Just before we start, see, not financial advice, usual disclaimer. So one stock to buy, let's take a look. Okay, so for this company, the first thing I want to determine is it a quality company? Is it worthy of consideration? We'll have a look at the gross margin. Gross margins seem to be in the 40 to 50% range, mainly in the high 40s. The ability of the company to have pricing power demonstrates pricing power, good gross margins, and the ability to absorb shocks on the supply side as well. With the ratios, I'm looking here at the return on capital for this company. That return on capital is consistently high. It looks like it's been around about that sort of 20% level, though earlier in the previous decade it was in the 30s%. It looks like it's a company that makes good use of its capital, so we wouldn't want this to be paying a massive dividend because the return on capital suggests that money could be better used internally. In terms of their operating profits, the operating margin percentages are over 20%, in the sort of high 20s, sometimes in the 30s over the last 10 years. So far, this company looks like it could be a quality company. I also want to have a look at the chance of failure, because it could be a quality company, but it's got a high chance of failure, and I'm not interested. So I'm looking at EBITDA over the interest expense, and that value is 32.5 at the moment, and the debt to equity is 44%. These figures are absolutely fine, and they do have a little bit of debt that they've taken on recently. They've got a very strong ability to pay that debt. In addition, the current ratio, although that's dropped down a bit recently, still 2.63, which is a very healthy value. So to me, probably quite a low chance of this company failing. Looking, the dividend is 2.64%, quite a low payout ratio, 29%. Future payout ratio is anticipated to be 43%, so dividends affordable as well. So they're not overstretching themselves. Keep a dividend going. Future growth is looking like 6%. At this point, have a guess what you think the company is. Drop a comment in the section below. Now, the growth estimates here are 9.65% a year for the next 5 years, and we saw 6.1%, I think, on Simply Wall Street. So, well, let's take 7%. So, if you had a guess at the company, it's Skyworks Solutions, founded in 1962. This is a semiconductor manufacturer. I'm just going to bring us across to my investing checklist because this is what I use to assess the metrics on quality companies. The average 5-year and 10-year return on capital employed is in the amber region, so it's above the minimum threshold, but it's not above the ideal. That's fine, in the 20s%. Gross margin average there, 48%, so it's actually a little bit below my target. Probably higher to maintain a high gross margin in this sector. Operating profits around that sort of 30% ideal mark. And the cash conversion, the ability to translate profit to free cash flow, it used to be 96% average over 10 years, but the 5-year average is 88, so it's dropped a little bit. Chance of failure we've gone through there is all green. And then the valuation point, which is very interesting. Valuation point is that the free cash flow yield, when I did this analysis, market price was 92.91 when I did this analysis. Free cash flow yield, 6.28%, which is above the ideal level that I want it. That's about a $15 billion or so market cap company. So we're not talking a massive, massive company here. I was looking for free cash flow yields, let's say, well, I wanted 7%, need to look at 83.42 the share price. Also done a discounted cash flow using my discounted cash flow model. And for a 10% return, that's a price of 94, 15% discount rate, price of 78. So at the current price, I did the analysis, 92.91, that's a 10.24% return estimate. So we've got good valuation metrics there because I want things that return 10% a year plus in terms of my portfolio ambition to hit £1 million by 2050. So this suggests that this could do that at the current rate. I've also looked at the change in shares outstanding, and the ideal situation is perhaps there's a small decrease in that, and it has been decreasing slightly over several years, an average in the last 5 years of 2.6%. So they are doing share buybacks, not on an extensive level, but there are some small share buybacks. There's a future growth. The current P was 12 at time of analysis. It could be 8 if this growth rate continues. So looking at the free cash flow yield, another way to look at the estimated return. Now we've said 10% sorry, 10.24 on discounted cash flow. Another way to look at the estimated return, I think Terry Swift has said this before, you could say what's the growth rate plus the free cash flow yield. At the current price, that would be a return of 13.3%. Just got some scenarios here just to see what different free cash flow yields would do using this formula, and therefore what the price targets are for different returns. So for the discounted cash flow, the price target is 78 for a 15% return. For this method, using the free cash flow yield, it's 73 for a 15% return. So I think this is all saying to me it's a good quality company with a very low chance of failure. Open an initial position, which actually since I did the analysis I have now done. Open that initial position, and then if we go down to what we've got there, 78 and 72. So if we get down into the 70s, there's probably a good argument for me to then increase that position significantly because we're getting towards that 15% return rate. Now, I do have exposure. I do have exposure to this sector already. Intel and Micron. This is still a high quality company. That's my overview of Skyworks Solutions. Are you looking for more positions for your portfolio? Check out the playlist on screen, which you don't want to miss. That's all my stock reviews that I've done. It may give you some interesting investment ideas.